Good afternoon, all. Good evening. I hope you are able to listen to me. Thank you for coming. This is the half-yearly review of 2023 Founders Portfolio Performance. And this, in the whole presentation, I will not only take you to the past, our thoughts, and also the future, what we think and what we believe will be. We also would like you to ask questions, and we would love to answer them and try our level best. Coming to the performance for people who would have invested in the last 1.5 year, there's a possibility that you still need more upside to make money. But anybody who came in 21 January or before that is absolutely benefited with us. And people who are a little bit down right now because of the last year high entrance, they will also get to see their portfolio up as the time will pass. I think the bull run has just started. So majority of you are, in fact, all of you are our clients, and we call limited partners. So I don't think so an introduction is needed. Just to give you the past performance since the inception, we generally have a track record from Jan 2020, because that's the time we moved to the Mauritius company under the interactive broker as our custodian. And the founders portfolio has delivered 74% return from that day till 30th June, which is yesterday. And if you look at S&P at the same time, is 34% plus roughly 4 to 5% in the dividend, roughly 43%. So roughly 30% of, you can say, is that outperformance on the founders portfolio results. Similarly, IWM, which is the Russell 2000 ETF, which is equivalent to 2000 biggest company of America, which is roughly at 13% kind of a return. So this is significant outperformance in the founders portfolio. Having said that, it has also fallen in November 2021, and last year was a year where I think, if you would have noticed, we were down minus 22%. So ups and downs will continue. Most important is that we have to come up the curve. Most important is that you and I understand that this is a 5-year journey, a minimum 5-year journey. And anybody who would have now, in our case, has crossed 2 years is absolutely happy in making money. People who have not made money in the last 1.5 years, we request you to understand how equity market works, because we share your pain. Because being in the profit sharing, in the performance fee, we totally understand what goes through the mind. But let's also accept that in the last year, a lot of people have lost their money completely. They're wiped out from the market, whether it is bond or structured notes or leverage. Now, coming to YTD performance, our performance this year is 19.79 in the range of 18-22%, depending on your portfolio. We try our level best to make sure that each and every portfolio mimics the same, but since there are withdrawals and deposits, so 19.79% is what founders portfolio has done till date for the year. Vis-a-vis S&P has done 15.91, and IWM, which is the Russell 2000 ETF, has done roughly 8%. So again, in outperformance, I'm just sharing this with you because a lot of you would like to see this chart. Having said that, we are not in the business of beating the S&P 500. If this happens, that's fine. Why that will happen and continue to happen over a long period of time, we'll see in the next slides. Now, what have been our learnings? Our learnings are very simple, that quality beats average. So when you buy a quality concentrated portfolio, this is gonna beat the average, which means you don't really need to have the whole S&P 500 to diversify and make money. This also means that buying quality companies in the ratio of 10 to 15 does not increase our risk. In fact, higher returns are lower risk. So quality beats average. We can see that some of the stocks in the portfolio, like Constellation Software, Copart, Skechers, and even Amazon for matter this year, are 30 to 40% range, where the index is just 11 to 12%, 15-14% range. So that is what the quality beats average is our learning. Coming to inactivity. Now, a lot of people, confusion on this, that an active fund manager is supposed to churn the portfolio. It's a very famous saying that activity is not the other name of achievement. Activity has no relationship with achievement. So what kind of activity we took? We kept patience. We did not sell your stocks when it was down. We didn't churn. We did not take the leverage. We did not flip from the companies. We did not remove ourselves from when the Amazon was down. So a lot of decisions we have taken outside the trading window, and that's active fund management. Choosing the right company or the best balance sheet is that's what the active fund management is. So inactivity is what the activity. I don't know, but it will be great if you will share with me privately or openly that you would have done a lot of trading this year. You would have done a lot of leverage last year probably. Are you making these kind of returns after doing so much of activity and involvement in the late night, because US markets are of course open from the evening to the late evening? So that's the question you need to ask yourself. We have learned these lessons long ago. So that's what is very important to us. Concentrated versus diversification. A very good saying is that the diversification is for the fool. But I don't really say that to all of you. If you are ignorant to the fact how equity market works, please continue to diversify. But diversify means we need to still beat the inflation, which means 8 to 12% return across all the asset class we need to make. So please diversify. But once people like us who understand how the depth of the stock market, the depth of that this is not a stock market, but market of the stocks, and I have to choose very few companies. In the whole world, the quality companies are very few. We have limited money, and my money deserves the best company. In those scenario, concentrated investing is a much, much better bet than diversification. There is a saying that after the 20th stock, the 21st stock adds very little value on the portfolio. Now, time in the market. We all saw, thank you to all of you, 99% of my investors have not withdrawn a single penny. They understood it, though they couldn't time the market. Many of you could not invest in the last 6 months or 9 months with us at least. And that is what you also saw, that timing is such a hard exercise. It is not only the fund manager, even the investors are unable to do it because of the simple fact that nobody knows what's the bottom. Like today, I'm sure a lot of you are feeling that now the stock market has already run a lot and it might not run further, and let's sell and sit on cash. But our learning is timing in the market doesn't matter. The banking crisis, the Silicon Valley Bank crisis, now Credit Suisse, they don't matter to us at all. The interest rate hike, a lot of people told us last year, please sell, because when the interest rate goes up, the stock market goes down. We wrote an article in August 2022 on LinkedIn. You can see that on my LinkedIn page, and I am on record that this is the time that the stock market should run. And that's exactly has happened. And I think the bull run is still left. We are still in the starting age of the bull run, and we'll talk about that when we get into the Q&A session. So interest rate also really doesn't matter for a long-term investor. Financial leverage, a very good thing. I'm sure a lot of people had leverage last year. I'll give you one scenario. I met this prospect of mine, and he has invested into Power Finance Corporation bond, which is roughly giving 3.75% interest. So a lot of the Silicon Valley bank scenarios have happened with a lot of our investors also. So they bought in 2021 when the interest rates were very low. They bought this bond and they levered, and after leverage, they were making roughly 5.5%. And they were very happy because they were beating the fixed deposit. Now, this bond was roughly 7 to 8 years maturity. Now, once the interest rate reaches 5%, now the bond is trading at 85, 87 levels. The net interest to client is minus 4%, which means client is actually paying to the bank. And that's why the financial leverage is very harmful. We got these requests for financial leverage, and we have turned down those requests of financial leverage. A very good saying by Warren Buffett is that if you are a smart investor, you don't need financial leverage. And if you're not smart, don't take financial leverage. So there's a very important thing is that leverage is not important to make this double-digit returns. Stress test of the bank. Just now we saw that all the banks in the US stress test was positive, and one investor mentioned to me day before yesterday that all the bank stocks are up today. Right, sir, bank stocks were up today for a day, but we would like to make wealth over a long period of time. We don't want to make this wealth on a percentage basis, that I make money today and then tomorrow I'm not happy. So daily basis, watching the stock market or Mr. Market price is not important again for us. What we have to look at, will I be making significantly large money in 5 to 10 years? And that is what matters to us. Now, next slide. So what is active fund management? Active fund management is about patience, courage, and imagination, being positive about the future, looking deep dive, because the devil lies in the depth. And while we keep low turnover, we have kept your brokerage charges for this year as zero, because not a single stock we have traded to make this 21-22% YTD return. We have absolutely not traded. If you have not given us more money, we have not bought or sold a single stock. Lower tax, the more you sell and buy, the more brokerage tax also you give. That's one tax. The second tax, which is not applicable for the UAE investors, is when you pay the capital gain tax, the short term and long term. But if you are trading in the Indian market, you will realize that you might be making money, but you're paying 30% to 10% capital gain tax. So that is also the active management takes care of. And third is low transactions. The more transaction, the chances of getting wrong is higher. So in the active management, we take care of these three. And a good saying by George Baker is, to make money in the stock, you must have the vision to see them, the courage to buy them, and the patience to hold them. And I think I would like to congratulate all of you, because very few people have inquired to withdraw money. Some of them actually withdrawn the money. But we told you that, look, you bought a stock at 70 and the stock went to 30 or 40 and came back to 71. Don't sell it, because now you are happy that you have not losing money. Hold on, give 5 years. And people who have given us just 3 years, they are at a 70% kind of a mark. People who have not given 3 to 5 years, I will request you to hold on and see this journey, because it's a life-changing moment. I know the Middle East is all about quick money gain. People have made a lot of money in property this year. I congratulate them. But what will you do now? Will you be able to buy property again now this year and take it more profit next year? Probably not. People who are 10 to 15 years in the property cycle in Dubai, they exactly know what I meant. So the very important thing is to understand that, since a manager, for example, let's say I've invested in a restaurant. Let's say the name of the restaurant is, for example, Haldiram. And if I'm invested in Haldiram restaurant, they are doing trading day in, day out. It's not my job to go and trade. My job is to be the partner of Haldiram. If I would have invested in Haldiram 10 or 15 years ago, probably they allow me to invest. That's the biggest challenge with these great companies. If I would have invested, I would have made equal money what Haldiram made. So very important thing is, I should not be trading because somebody else is in charge and he is making sure that I and he, or as a shareholder, me, and as a promoter, he makes the money. So that's why it's very important to understand that we have to sit long on these stocks. My responsibility is to find the great companies and make you sit on those companies. Your responsibility is to make sure you question me on the company selection, and you also have to see that I have kept the risk low, because I strongly believe that risk comes from not knowing what we are doing. Now, what are we adding new in our analysis? Something new has to be definitely added to the stock. One is the new stocks, and the second is how we are going deep dive on the stock investment. As we go deeper, we also feel that stock investing is not for everybody. It is absolutely not for the faint-hearted one. It is absolutely not for people who just look at the price ticker and they think that by looking at the price ticker, they can move the price. So it is absolutely not for people who are not willing to look into details. So if you can read Saurabh Mukherjee, who is the masterless investment manager, in one of his book is very clearly said that if you cannot read 3 years balance sheet of financials, give it to people like him or me to manage. But if you can read it, then it is for you. So what we are doing now in the forensic screening, we are enhancing our checklist and we are going deep dive, which is very difficult for me to explain here. But I would like to tell you that there is something called cash flow from operation and there is something called earning before interest, tax, and depreciation. It is very, so in the financial, there are three parts. One is the balance sheet, one is the cash flow statement, and the third is the income statement. I'm sure this basically our investors understand. Now, what happened? The very easy part to manipulate is the income statement. And a lot of us are very happy seeing the income statement that income is growing. But what happens is this is very easy to manipulate. But the cash flow statement is the real cash come in the company and goes out from the company. This is very difficult to manipulate. So what we also now looking at is the cash flow by EBITDA's consistency. For example, in Copart, one of the very good, one of the best performing company in the portfolio has a 78% ratio of cash flow from operation divided by earning before interest and tax and depreciation. So what does that mean? Company is actually getting 80% of this investment, the money, and it is the retaining from the income. Similarly, in this Sketcher, it is 60%. And this is a good number. It's a very good number. And if, let's say, it is varying a lot, and let's say it is lower, then there is an alarming sign. And that's how we can avoid these kind of investment or this kind of stocks, and we might not touch them. Now, one more thing is, they say that whenever an empire is collapsed, somebody from the inside is always part of it. And who else, nothing but the auditor in this case. So when the Satyam computers the Satyam computers went down, it was the auditor. When this company, this juice company in India, when they had an issue, auditor resigned twice. So auditor remuneration, are we paying auditor very high, very heavily, or is it growing very fast? Those remuneration also can sense that something fishy going on. So on the Copart, if you see that they have basically the sales growth has been 14% CAGR in the last 10 years, but the auditor remuneration has only grown by 4.58%. Similarly, the Sketchers case was a little bit high. It has grown 11.41%, but the sales has grown 17%. So how do I check on the Sketchers? So what I will do is that I will go to the industry, all the shoe making company like Nike and Puma and Adidas, and I will check if this is a very common scenario for an auditor like BDO. BDO is the auditor for Skechers, and that's how I'll come to know whether Skechers is doing some manipulation on their income statement or balance or financials or not. So that's one more forensic check we are adding on our portfolio. Now, third is the goodwill. Now, goodwill is something very intangible, and you can just siphon the money by acquiring a company and paying them a huge amount as a goodwill. So if the goodwill is there in the annual report, it means and it could also mean that CEO is siphoning that money. So what percentage of goodwill is there in the balance sheet is something which we can also figure it out, and then we can compare in the industry. So Skechers has a very small goodwill of 0.57%, where Copart has a 14.26% goodwill, which is also okay, it is not above the mark. So this is one more way of figuring out is some siphoning is happening or not. The fourth one is frequent change in the auditor, which we saw in Satyam Computers and which we saw in this mango juice company in India. I forgot the name. So in these scenarios, what we found is the Ernst & Young has been the auditor for Copart since 2006. It's a really long period. And in the case of the Sketcher, it is again BDO has been auditor for last 10 years. So this 4 parameters have been added in our forensic check. We had a lot of time to actually figure out, we wanted to buy best companies, we wanted to retain the best, we want to remove the worst companies, and that is why we are going further now and doing forensic check. We'll also share with you how we got these parameters, which book we are following, and what are these checklists. Soon checklists will also be uploaded in the website. So even if you are buying individual stocks, you might want to do this checklist, run a checklist before you buy a company. Now, the fifth one is share buyback program. Now, when company has got huge cash, they should buy back the shares if they do not have a plan to grow. But as you rightly see, Copart does not have any share buyback program going on. Copart definitely is growing big time. You can see that cash flow is also very high. So Copart is a company which does not feel that share buyback is needed. Whereas Skechers is doing a buyback. Now, this is a very subjective evaluation. When a company is doing buyback, it means they have money. It means they have real cash, and it is a manipulation is lesser. Now we have to also figure out if these buyback are in a relevant point of time. And what we saw that Skechers was, if you look at this year, Skechers has, I think, rather 50%. So the point here is that if a company is buying back their shares and they have lower growth opportunity, it clearly says that company believes, the management believes in the business. They themselves want to reduce the number of equity to increase our returns. That's a right use of cash. Apple is a great example, which has just become $3 trillion company, has been buying back their share for the last 10 years. So Apple, a high growth company, a great company, is still buying back their share for the last 10 years. And I think I have told this earlier also. They have just given 9% CAGR return by buying back their share and reducing the number of equity. So buying back is also a great way to check how these companies are up to. Now, accounting period. This is also very important. So I think I was reading this book called Diamond in the Dust, and there I found that before the all this nuisance starts, what these companies start doing is they basically delay their filing. So they change the filing period, etc. Because all this financial jugglery they have to do to hide something. Now in both the company, we found that they had no change in the account period in the last 10 years of the history available. Now this is the way we are enhancing our research. This is the way we are adding more value, and we are going to do this across all the stocks, whether in the portfolio or coming in the next in our portfolio. So I hope this made sense to you, because many of you said that now you have bought these companies and now you have nothing to do, but that's not the case. The case is we have to frequently monitor the portfolio. We have to talk to these management, and we're very, very lucky to talk to this company called Expel, which is roughly doubled in the portfolio since we bought. It's a very small position, but we feel it's a 50 bagger. We still have some questions which we have asked the management, but we were very fortunate to talk to the CEO, Ryan Pep. And Ryan Pep told us that 3M is our incumbent player. It's a very big player, but Expel is having an approach of entrepreneur. We think everything is an entrepreneur. We think of business that as of like we are buying, we are selling for our own self. And now Expel, so I don't know how many of you know what Expel does. Expel, let me take you to the website of the Expel for 2 minutes. We'll get debated and let's do a detail on this. It's a high performing stock. So before that, also let me just take you to the Expel share price performance. So it is 42%, and I believe we bought at 42, 45 level to start with. So roughly in 1 year, we would have been roughly at 85% return. You can check your portfolio on your own. Now, expel.com is the website. This company has the highest ROC among the best performing company. ROC is return on capital employed, which means the promoter is generating 30 to 40% return on their own deployed capital, which is the cash plus the debt. So now Expel does PPF. Expel has done a lot of forward integration. They have bought a lot of garage. PPF is a paint protection film. When we buy a luxury car, luxury cars have this tendency of, because of the speed or because of the rocky mountain or the harsh weather like winter, or I don't know how much it is good for the Dubai market, but in the winter and the rocky weather, what happens, the car's paint get corroded. And to protect the paint, there is this petroleum film, which is a very technical product called PPF. And paint protection film, it is just an advanced version of tinting, because we use this tinting screen, tinting for the sunlight or UV rate. But PPF is little further than that, and PPF also save the car against the dent and chipping of the paint, etc. And that's how it increases the resale value. So I also want to tell you here, the market for luxury car is increasing at a higher percentage than the normal cars. So PPF serves to the luxury car, PPF serves to the export cars, and it helps you to increase your car value by 5 to 7% when you sell it after 4 to 5 years. So this company has grown by not only organically, but also buying the customers, which is garage. Garages are the skilled people who use this PPF film. It is cut through something called the depth software, and the depth software has the pre-made cut for the Ferraris, for the Lamborghinis, for the Range Rover. Now, what company is mulling over? Company is thinking of starting their own manufacturing. So the forward integration, the lateral integration, and now the backward integration. And that's why I want to tell you that this is how the company would like to maintain the ROC and growth. So this is one company which is a continuous growth. And what we were trying, so I was trying to tell you that how do we add value? How do we get more confident? We still have some questions pending on the expel, and that is why we're not increasing the allocation for expel. But from the performance wise, from the company's thought process, everything is fine, but we still need our answers on the financials. That kind of value we add, not easy to get the answers. We don't get the answers so often, and we keep writing to them. I think 4 emails have already gone to them. Stock is running, but we don't have the answer yet. This is the kind of value we add. That's what I'm trying to tell you. So now the very important thing, the P illusion. A lot of us see the price to earning. First of all, this price to earning you should not see. You means we should not see, because price to earning is a very what do you call a kind of illusion. Why it's an illusion? Because that year it could happen that the earning of the company is very low, or there could be a reason that the earning might not come from operation, and it would have come as a one-off investment sell, and that's how the earning would have been inflated, and price to earning will look low. So a lot of people have talked about timing, and this is again one slide where we would like to tell you about timing. I will also recommend a further read on Terry Smith. Terry Smith is a $13 billion fund manager out of UK, and he said about this particular thing called high P company. So if you buy a high P company, you'll still make money because of the fact that they are growing at a very high speed. And it's a very simple thing. If you are running a great company, will you sell your company at a book value? Never. So this is basically a very important thing to understand. If you would have bought Copart at 25p in 2013, or Constellation Software at P of 48 in 2013, or Amazon at 675p in 2013, the share price has still grown from that price to earning multiple to 9 times, 11 times, and 5.41 times. What I'm trying to tell you is that quality companies will not come cheap, and that's why timing adds very little value. And time in the market, because a 10-year period is something what is great. Obviously, in 5-year, Amazon would have given us 60%, which we might not be happy with, but still, I think it is much better than the fixed deposit. So what I'm trying to tell you is that price to earning is an illusion. High P is an illusion. Asian Paint is still at a very high P multiple. So great companies which have a great huge runway to grow, like Expel for that matter, is a high P right now. But look at the Expel size, a $2 billion company, where the 3M is $80 billion company. So how the company will transform itself, even company does not know. For example, Amazon started selling books, but Amazon get into AWS, and AWS become a success. Amazon now got into advertising, that become a success. Amazon is into now something called Amazon Business, which is running a $25 billion sales revenue. All these, as per Andy Jassy, if you read his letter, was something very not even known to the company. They did not even know that it will become successful or not. So price to earning is not important, guys. Timing is not important. We're all lucky that today also from here, stock market looks great. We'll discuss that in the Q&A. But what I'm trying to say, even if you bought a great portfolio, not single stock, a great portfolio at a high multiple, like in 21, like some of our investors who made in 21, they still are not up. But so is the Apple. If you would have bought Apple in January 2021. So I told you one news that Apple is a $3 trillion company now. But is it happening for the first time? And that's not the case. So Apple had achieved this $3 billion market cap earlier also. When? So look at this particular time, Apple has reached $3 trillion mark here as well. So anybody who invested in this time zone is now just doing roughly what? 8% return. So this may happen, and that's why one should not have a 2-year horizon. But why do I not do timing? Because if I will sell here, I won't be able to buy here. It's not easy, because you sell here, you would like to buy somewhere here, and it will add very little value. So what I'm trying to say, the best company of Apple, where in 5 years somebody would have made 4 times return, is also not delivered in the last 2 years. But if we would have waited for 5 years or 3 years, returns would have been great. And that is what my message on the timing and the P. So P is an optical illusion for the great companies. So now we are in the watch list. So what are we cooking? Where are we? What are we working on? We are working on some companies. One company is an online casino provider, which is growing the sales at 50% CAGR. The free cash flow is growing at 68% for the last 10 years. An amazing company based in Sweden. I don't want to disclose the name. I don't want you to buy also, because again, you will buy it for 10, 15, $20,000, but you'll not understand that this is a 10, 15 years company from here, because we would like to make 10 times return. So anyways, this is our shortlist company. We're doing more research. The second company, it's a B2B solution provider to biopharmaceutical business. They say biopharma is helping the whole pharmaceutical industry to reduce their cost. In America, I visited recently, and I'm sure you would have been there as well. America, the healthcare cost is very high. In 2010, one biopharma medicine was among the top 10 pharma company. But now in 2020, 6 biopharmaceutical medicines are part of the top 10 pharma pills. So what I'm trying to say, this company is not like trying and testing, because one drug required 2 billion euro of investment. This company is not selling drug. This company is selling the drug companies to make new drugs. And look at the sales growth, look at the free cash flow, look at the what do you call, the share price growth for the last 10 years. And this is the kind of company we have shortlisted. Unless and until we get a room in the portfolio, we cannot. So how tight is the portfolio become? But these are some selection. The third company is cloud computing company, which is focused only on the life sciences and pharmaceutical application, where again, the figures talk something great. The fourth is a trucking company, which is even FedEx. Is not a FedEx, by the way. FedEx also praised this company a lot. They're into last mile deliveries. They own their own warehouses where they do this assortment of shipment. This company has also grown their free cash flow at 44% CAGR for the last 10 years. Share price has grown more than 33% every year. Again, a shortlisted company in the portfolio. We're learning to more about the company. At the right time, we'll enter it. And the last company is the stock exchange. The stock exchange is a unique exchange, unlike NASDAQ and S&P 500 exchanges. This is basically, again, growing the ROC. The ROC is 75% average. The sales is growing at 11.52%, which is a little lesser. But this company has delivered a great 24% CAGR in the last 10 years, which is roughly 10 times in the last 10 years. So these are the companies we are working on. That's how we are spending a lot of our time, apart from knowing and learning more about our existing companies. And this is a watch list. This is a kind of a quality we're going to enter into. And I don't think so we need any leverage. We need any sort of other instrument to make money. But one thing is very sure, that patience is warranted from each one of us. Now, coming to inflation. I think I have some questions. Let me see. Okay, you can see the screen now. Please, can you press a thumbs up? I think you can see the screen, I believe. So if you have any question on the presentation you're not able to see, we'll definitely forward it to you. But now coming to the very simple equation is that inflation. Now you saw that inflation is high and the stocks are going up, whether it is portfolio or the market. And this is called good inflation. People who are very, let's say, who want to do trading, they can follow a man called William Larry. I read him, I watch him, but my whole idea is to be on a fundamental side. And I just derive from him that how fundamental looks. A very good term he coined called good inflation. Now, what is good inflation? Any inflation which is with the growth is good inflation. Now, input inflation have gone down. Anybody who's into branded business knows that the raw material is now cheap because interest rates have gone up. Just to give you an example, Vedanta is struggling to collect money. People who are familiar with Vedanta bonds, they know that Vedanta's rating was downgraded, and now Vedanta has been forced to explore to raise money through Hindustan Zinc. Why am I mentioning Vedanta? Vedanta is a commodity company. What my point is, the commodity companies sell to branded company like Apple, Amazon, Google, etc. So Apple's laptop are made of aluminum, Amazon devices are made of plastics, etc. The point here is that when the commodity companies which are highly capex oriented or highly debt laden, when the interest rates have gone up and they're still going to go up, and the interest rates are going up to protect us against the inflation. What happens is these companies have to reduce their prices because they need cash flow. They are unable to perform well because this money is going for debt repayment. But when this input inflation is passed on to their customers, where we are the end consumer of these companies, they are not passing on to us. As a customer, we have to pay more. But as a shareholder, as a part owner of these companies, we are making money. And that's why it's good inflation. It's gonna stay roughly, if some bad things do not happen, it will be at least there from here for the next 1 year. And since the inflation is good, this inflation is good, you will find that these companies are gonna mint a lot of cash flow, and that will translate in a lot of wealth creation. That should translate into a lot of wealth creation for all of us in the next 6 months to 1 year. Having said that, it doesn't mean I'm going to time it, but you have this question always that is it the right time to invest? And for that, I'm telling you, this is one thing. The third thing on the technical side is from July onwards, in the last 20 years trading session, market has been bullish, except let's say 1 or 2 year scenario. Mainly from July onwards till the December end, the market has shown bullish indication. One more simple reason is when my denominator is reducing because the inflation is now at peak and it is going to go down. So let's say interest rates are not going to look very more, let's say 0.5 maximum, not more than that. So from then what happened is that what is my stock price? Stock price is discounted cash flow. Now my cash flow discounted with the interest rate. Interest rate is nothing but risk-free rate. What is that? Treasury rate. Now treasury rates are not going to go up, or they're not looking up more than 0.5%, let's say. So what happened? The future is looking that my denominator is going to go down. My numerator is going to go up because I'm not passing on the input inflation to the consumer. And that's how Apple, Google, all our portfolio companies or quality companies are going up. And that's how the good inflation is bringing the next bull market. Now, why the bull market just started? Because if you see, the S&P 500 7 companies have done a great job this year. But S&P 500 493 companies have yet to catch up. And how can we see that from here? Is also we can see from this chart, where the Russell, which is the top 2000 companies, is only 8% up, where the S&P 500 is 15.91% up, which means there's a huge gap to catch up by the quality companies. It doesn't mean everything will go up. So that is why the bull market is yet to happen. Now, many people will sell Apple because they would have bought at the top in 21 and they will now sell it by making 8%, thinking that I did not occur a loss. Don't do that. If you have bought a company, I again repeat, know more about these companies, don't have a single stock philosophy, and hold for 5 years at least. So now we come to the recommended read. Now we are reading these books, financial science. It's a very difficult word to pronounce. This is basically a good 12-point framework by Howard, where he talks about how you can have the forensic check on your company. In the days of, by the way, we were looking for one company and everything was looking good. And then we ran this forensic check and we found that the company has a Hindenburg report on them. And we said, wow, we got this saved. So we had this company which we were looking for, and it's a glass manufacturing company out of US. And they sell the whole 97% of shipment only in one state. And then we saw a very detailed Hindenburg report and we said, maybe he's wrong, but we don't want to take a chance. So this is what the forensic adds a lot of value in detecting the accounting gimmicks and fraud. A lot of market news help us. Having said that, each and every good company, like as we talk, I'll share the news with you. Amazon is running into scrutiny because Amazon scrutiny, the way they are dealing with Amazon Prime investors, Prime customers. So see, they are actually facing antitrust scrutiny from in the UK and Germany. The way they are not allowing people to disconnect from or unsubscribe from the Amazon Prime. So it doesn't mean that there will be no negative news. There will be news. you need to figure it out whether they are good or bad. For example, Skechers always have this news of infringement of trademarks. Earlier days, Skechers used to pay. Now people are paying Skechers. I don't know what they changed, but it was very famous for Skechers that they used to copy the successful brand, and that's how Skechers have only been investing on the successful product of Nike and Adidas, and that's how they have grown. But every lawsuit is settled by giving some money or here. So it's not that financial fraud. It's a common practice probably in the business. So that's how we have understood. Now, Diamond in the Dust is an application of this book called Financial Shenanigans. This is written by Saurav Mukherjee. It's the latest book by him, and it's a great application of the principle written by Howard in the Indian stock market. And the checklists are given there as well. Same thing can be used for the US market as well, or the European market. So it's a recommended read for all of you. Those who are interested in further reading, and they're very good investors of us, please send an email to us. We'll be happy to give you Diamond in the Dust as a gift, because we want you to understand that we are here for you. Whether your money is managed by us is not important. You should not lose money. Lose money means not that your portfolio is down today. You lose money means you should not permanently lose your capital, because your money will be definitely made when, and by the way, our returns are yet China has not contributed. So Chinese market is still down, and I'm hoping that question will come from you. But even then, we are beating the index. So think about it, if Chinese stock would have come up, and it is not a problem of mine. People who have invested in Alibaba and all, they know the pain what we are also sharing with them. We bought some best companies there, but Chinese market people have lost faith. Does it mean that the what do you call the confidence will not come up or come back? But if you see, each and every bank or investment bank is very positive in China, but it takes some time. In fact, China is behaving very differently. The whole world is increasing interest rate. China is reducing interest rate. So we would not want to call it a short. We don't want to sell Chinese stock right now and book a loss. We want to hold on to them because we feel that they're unnecessarily depressed. And we can't talk much about politics, but I think you all know better than us, because your individual exposure to China might be higher than us. Now coming to the third book, The Intelligent Quality Investor. So it's a different angle. It's a very different angle to the investing. If you would like to have spend more time, read this book rather than trading on the trading window, because that is not going to make you learn. This book is also teaching us how in the future we can avoid volatile stocks. Though volatility is good, but we have noticed that in this part of the world, people don't like to see their portfolio down even for a year. And we are trying our best to buy companies which are also very constant growing. For example, let's say I bought Constellation Software for all of us. Constellation Software. So this is a company, there is a very good saying. Whenever you want to buy the company, in the next 3 years, you will have 10% CAGR. So if you look at this company, people will not get a chance to cry. Maybe this is one point where people might feel, but eventually this company has a consistent growth. But if I would have bought, let's say, Skechers for all of us.
Sorry to interrupt. I think you were sharing another screen. So if you could share that.
Okay. Sorry. Thank you. So what I was saying, I'll just repeat. So Constellation Software, if you would have bought, what I was telling you that this part of the world, we felt that investors also need low volatility stocks. And that can come only with a very, very high quality, means the good margin on the earning expansion. The companies which are very much immune to the inflation shock, which even Amazon is not, like an Apple kind of a company. And then investors will be more happy. And our job is to keep you happy. But at the same time, we also want to make sure that we make money. So Constellation is an ideal company for Middle East investors because it has always been running smoothly on this kind of trajectory. Vis-a-vis, if I would have bought Skechers, which I have already bought, and this kind of company in future, I need to avoid, because if you see so much of volatility in the Skechers, in fact, it's a cyclical company. See this kind of a J curve, and then it went down and gone up. So investors have these issues. I've seen that. For example, a lot of people tell me, you bought Huya and what's happening to it. So I'm saying we are going to that pedestal where we would like to give you companies which are less volatile as well. And this book is helping us to find those companies which are also less volatile in their earning returns. So it could be a good dimension for you. It is a good dimension for us, and I'm trying to understand that. And then whenever we get this bull run and we replace 3 or 4 companies, we are going to get into these companies which are going to be less volatile. We're not promising you, but at the end of the day, your smile is everything for us. So this year returns are talking about it. People who invested in 21 January, they are very happy. We would have been very happy if 22 January investor would have also understood that how stock market works. And I'm sure you all agree timing is not possible, because I've gone to each one of you. I've written email to you also that now I'm telling you the market is bull, but I think I did not get that notice, and I also don't want to come to you to ask for more money. I want to deliver the way this year has been good, and the year ahead, the second part of S2 is going to be good as well. So this is what I want to tell you. If you have read 100 of books, you're functionally illiterate, and you will be incompetent because your personal experience alone are not broad enough to sustain you. So we need to read books. We will be happy to give you books. If you like any investing books on our website, send an email, we'll send it to you. That is the kind of commitment we have. We cannot take you to the expensive restaurant for dinner, but we can definitely help you to understand why we are gonna come out as a good partner for you in the wealth creation. Now, some food for thought from my mentor and me. If your returns don't beat inflation, you actually are losing, not making money. Greed overtakes caution, and history repeats itself. So now there will be a FOMO in the stock market, and you will see a lot of good runway. As that's what I think. I can be wrong. I'm not giving you a direction. And then again, the bust will be followed next year. That's what I think. By the way, bankruptcies have increased this year. I also want to give you other view. So bankruptcies have increased, but so much money is printed that the economy is still resilient in the US market. Quick speculative investing is like a crash diet. You may have one of successes in losing weight, but in mid to long term, it causes more harm than good. So let's say we make quick money, it is definitely going to go down that ring. And a good food for thought for all of us: why business money, which we make in business, stay with us, because it also doesn't come easily. So stock market money also, if we make in 5-6 years a good money, it's going to stay with us. Creating real wealth is about multiplying your money several times, so over a reasonable period rather than regular percentage returns. So here is a very important thing which we want to tell you. If you have noticed this slide which we shared with you on the this one, we talked about times: 9.2 times, 11.6 times, 5.41 times. So all I'm saying is, let's think on times, that how much money I want to make in the next 20 years, 50 times, 30 times, 40 times. Let's not think small, but it doesn't mean we start investing into Bitcoin. So all we are trying to tell you is that we should not think in percentage, we should think in times. I'm here with you for the next 30, 40 years till I'm alive, making sure that we make a 15% kind of a return, which is doubling money in 4 to 5 years, and maybe in 20 years, 30, 40 times. That's what my aim is. That's how I see you. The fourth quote is, wealth creation requires active involvement. Now here I would love you to get involved on the stock selection basis, because I cannot control the stock price, but I can control one thing for sure: not to buy the bad company. And you can help me in that by poking your finger or nose, and that is what, or maybe asking the right question. So wealth creation is not that you have given us the money, you've forgotten us and said, oh, you have not made money, we don't want to discuss with you. It is a actively involvement between you and us, and that's how the wealth is created. Active investment, which I told you, is about monitoring your portfolio, not churning your portfolio. I will be very happy that if you come openly and share that you would have been, I'm sure you will be okay to share that you have traded this year actively and still your returns are less than 15-20. If you have made 30-40%, would love to learn from you, because I think maybe something we are missing. So active investing is about monitoring and not churning. Some food for thought from my side on a similar lines: changing the country won't change the returns unless one improves his investing style. What does that mean? That if you are seeing that Indian fixed deposits are better than the US fixed deposit, and if you start fixed depositing money in India, is not going to make you more money. We all have done that mistake by buying FDs there in India. or buying houses in India or our home country. So we have to change our investment style. Everyone has a moral duty to beat inflation. This is what when I go to school and colleges, I tell this is a very important thing that we need to teach our children and we need to teach ourselves that if any of our investment over a 5-year period is not making 8 to 9% annualized return, we're not beating inflation. This is something is our moral duty. Third is very important. Greedy people don't get to keep their money. So Vijay Mallya is an example in front of you, in front of us. There are a lot of this Forbes 40 under 40. There's a very good saying that all this Forbes 40 under 40 lands up in the jail. So what I'm trying to say that if we make a lot of money faster, we will not get to keep it because the weight has come, the weight will go. Now, Gita is promoting inaction. A lot of us misunderstand that Bhagavad Gita is promoting action, but Gita is promoting Nash Karma, inaction. The fifth is wealth comes to those who create virtues inside and around them. You are helping me to create virtue. Today, I cannot serve to each and every investor because a lot of these people have this requirement of $100 investment should never go down. So a virtuous circle, you understand as a businessman, you understand as a senior employee that the wealth is inside and not outside. And if we have good qualities and virtue, which these companies have on the portfolio level, eventually they will be beating the other companies, and they will have a lot of money following us rather than we running for them. The quick money is a door to hell, a repetition of what I just told you. To make a lot of money, we have to start thinking in times. And that's my request to all of you, that look for 10 times, 5 times, whatever single investment you make, whether you make on your own or in a property or with us, think of this as making 4 times, 3 times, 5 times to start with, and not just in taka or percentage. And that's how I think a lot of money will come to us in our investments. I'm open to question and answers. I think we have taken this call till 5:15. Thank you for being patient and listening to me. Lines are open. Please ask. Feel free to ask questions on the portfolio in the future. No questions? Any question on company level, on the future, on how the market looks from here, when the crash is going to come? Yeah, I got one. Okay, thank you, Ankita. So I think there's no question. I think please feel free to ask questions or send your email to us or on WhatsApp. I'm always available. The recording will be shared with you. Thank you for attending the half yearly 2023 call on the founders portfolio. I think a lot of money to be made yet. It's a learning journey for all of us. This part of the world needs a lot of value investors and value investment fund managers. All I want to tell you that please, while making money, also think of the risk. We absolutely perform and operate in a low risk environment, and I strongly believe that you need to also understand the risk first before thinking of the returns. So there are 2 risks which I would like to end with. One is I am not making enough money, so I should not buy any investment which is making me less than inflation. So if you are making 8 or 9%, great. That's one. The second thing is I should also not focus on making 40% and take a huge risk because I don't understand what's happening. So we are always attracted towards this 8% kind of return and 40% kind of return. And what we are doing is basically a midway. And this is small pagdandi, not everybody is ready to walk. And this is what I am walking with you and holding your hand, and you're holding my hand. And this is what we need to do. Now, this is something very important. The second message is in the investing and in the life, Simple beats complex. Don't make complex investment decisions. Avoid financial hazards like structured notes, leverage, accumulator, decumulator. Please be away from them. Keep things very simple. The life will also be very simple and a lot of money will be made. Thanks a lot for joining. Have a great time and a great day and a great holiday. See you soon for the yearly founders portfolio call. And I will also write to you the 6-monthly letter. And I'm sure I'll learn a lot from you. But please next time ask a lot of questions. Thank you.